So see here, we are solving a question from FR. So Duggan Company. The following extracts from the trial balance have been taken from the accounting records of Duggan Company as at 30th June 2008. So what are the extracts they have taken? Convertible loan notes. There is an adjustment with respect to this. Okay. In examination, they won't give all this. You have to understand. You have to read the question and understand where the adjustments are. So they have issued convertible loan notes worth of this much amount, three zeros omitted. Cost of sales is given to you. Finance cost, again, there is note. Expenses are given. Investment income is given. Operating expenses, again, note. Retained earnings, opening balance, revenue, equity share capital, tax, expense. So let's start the question. So, when we start the question, we always start with revenue, and revenue already has a note. We will see what the note is there with respect to revenue and try to solve it. Statement of profit or loss of Duggan Company as on 30th June. First is revenue. So what is the revenue amount given? 43,200. With respect to revenue, there is a note. Let us see what is the note. Duggan Company entered into a contract. So, when you enter into a contract, you have to construct something and give. Okay. So this contract, there is a performance obligation. That means Duggan Company has to construct or make something and give it, and is satisfied over time. That means they will not immediately deliver anything. They will make it within some time, and they will deliver the product, or they will, whatever the obligation they have, they will fulfill that one, and then they can charge the revenue for it. The total price on the contract is 9 million. So 9 million is the price, with the total expected cost of 5 million. So 5 million is the cost. Progress towards completion was measured at 50% on 30th June 2007. So previous year, till the end of the previous year, they have completed 50% of the contract. And they have completed 80% of the contract this year. So this year, 30% extra they have finished. The correct entries were made in the year ended 30th June 2007. So they already recorded 50% of the revenue for this contract. So 50% of 9 million will be 4.5 million. They recorded already. Okay. The correct entries were made in the year, but no entries have been made for the year ended 30th June 2008. For this year, the rest of the 30% they did not record, which we need to record. Okay. So actually, 80% of the work is done. That means 9 million, 80% will be how much? So we'll do working notes also simultaneously. 80% of the work is done. So 80% work done, 80% of 9 million would be 7.2 million. 50% they have recorded. 50% of work done, 4.5 million they have recorded. So how much they need to record? The rest of the 30%. Rest of the 30% is 2.7 million that they need to record for this year. So we will record it. Okay. Plus 2,700 for work done. So the whole figure becomes 7.2 million. Okay. That is till date, because 80% of the work is done. Rest of the 20% work is still left over. That is 1.8 million. That they will do over a period of time. But we need to record how much work we have done till date as per the extra information. Okay. So I have done that. I have recorded the 30% part of the work which is done in the current year in the revenue section. So my entire revenue becomes 45,900. Okay, this is amount. Now, see, let me tell you one thing. When 30% of the revenue is recorded this year, it also impacts 30% of cost. Okay, because we measure the revenue and the cost based upon the progress in the work, based upon the amount or quantum of work done in the year. So here you can very easily check one point. Cost of sales is given as 21,700. Okay. They have given both the information. Duggan company entered into a contract where the performance obligation is satisfied over time. The total price on the contract is 9 million and the total expected cost is 5 million. So we have to match the revenue, the excess or extra revenue of this year, the 30% part of the revenue with 30% cost. Okay. So we will do that. This was with respect to revenue. So revenue. Now cost. So same thing for 50% of work done. So 5 million is given. 5 million into 50%, 2.5 million. 30% of work done, 1.5 million. Total 4 million work is done. That means 80%. 20% is again what? 1 million. So we don't want. We want only how much part in this year? The 30% part. So 1.5 million we will add with cost of sales, because this year, whatever the contract we have taken of that 30% work we have done, we have recognized the revenue. With that revenue, of course, for every single penny earned, there has to be some single penny spent. So we have also, incurred this 1.5 million worth of expense. We are going to match this with the revenue to find out the real profits. So cost of sales. 21,700. So cost of sales comes out to be 23,200. So my gross profit would be, this is my gross profit. Till here, everything is okay. So we will move forward. Now, first adjustment totally done. Please understand what is the second adjustment all about. On 1st January 2008, that is in the mid of the year. The year starts from July 1st, ends at June 30th. So July 1st, 2008, the here we are, 2007. The year starts and it ends at June 30th, 2008. So in mid of the year, Duggan company was notified that. So it came to their notice. The management has notified that an ex-employee had started court proceedings against them for unfair dismissal. So Duggan company, they're running a company and there is some employee with them. They had a dispute regarding unfair dismissal, and he has started the court proceedings against the company. And the legal advisor has said that there was an 80% chance that Duggan company would lose the case. So this is a sheer case of provision. I will explain why. And would need to pay an estimated amount of this much on 1st January 2009 after a year. Like after a year, 2008, then 2009. Like year from Jan to Jan. But June to January again, 6 months, right? Based on this advice, Duggan company recorded a provision. Fine. They recorded this much. That means they have to make a provision, it seems. Why they have to make a provision? Because, 80% chances that they will lose the case. So if it is more than 50% probable, okay, that there is some kind of obligation you would have in the future, you need to settle down that you need to pay something. There are 50%, there are more than 50% chances, then we recognize provision. There are certain rules with respect to provisions. You will be studying in the chapter called provisions and contingencies. Less than 50%, we won't create a provision. More than 50% chances, we have to create a provision. Okay. So here there is more than 50% chances that they will lose the case. So if they lose the case, they have to make the payments. They have to pay the amount to the employee. So they will make a provision. Okay. And payment will be made after a year. When are they going to make the payment? 1st January 2009. They discovered on this day. Yes or no? Yes. So everything is clear. Duggan company's employee has filed a case against them for unfair dismissal, and there is more than 80% chance that they will lose the case. That's what they have said. Now, legal advice was that there was an 80% chance. Oh, sorry, not more than 80%. 80% chances they will lose the case. That is more than 50% probability of losing the case and making the payment, or this has created an obligation for them that they have to make the payments in the future. More than 50% chances. More than 50% chances. Why? Because 80% they will lose the case. And the estimated amount what they are supposed to pay is this much. That is a future amount on 1st Jan. So based on this advice, Duggan Company recorded a provision on 1st January 2008. These dates are very important. That means in the mid of the year, they recorded a provision. How much is the provision they recorded? So we make working notes. 800K they recorded. How much it should be? So how much it should be is actually you have to take this amount, which is the future value, and find out the present value of this. So we will do that because this amount is paid after a year. What is the present value of that as on today? The discount factor is given. No need to worry. And they have recorded the provision also in operating expenses. So Duggan Company's cost of capital is this and the discount factor is this. So we'll make the present value of this. 1.012 into 0.9091. It comes out to be 0.920, which is almost 920 million. Okay. Or 920K you can write down whatsoever. So they have to make this much provision. Actually, they made how much provision? This much. So the requirement, now we will read the statement. Based on this advice, Duggan Company recorded provision of this and had made no further adjustments. So they need to make the further adjustments. Actually, they have to make this much. They made this much. They made less. So they need to add more amount because they need to pay that. Okay. So 920K minus 800K. That is three zeros omitted. So it comes to be 120K. This much more provision they have to make. And they have to show in the operating expenses. Okay, so we will do that right now. Operating expenses. So second note they have given. $120 came from the provision part. $120. So one more point with respect to this would be, see this whatever the 920 we are supposed to make the payments. Okay. There is one more adjustment here. Yeah. Okay, fine. We'll go line by line. So see, when they have to make these payments, Based on this advice, Duggan company recorded provision on 1st Jan and has not made any further adjustments. So they have to make the payment on January 1st. Okay. So how much they need to make the payment? 920, 120 extra they need to make the payment. The whole obligation created for them is how much? 920. Okay. This obligation got created for them 1st January. And we have to show the statements at the end of the year. Right. Okay. Next adjustment. We will go for the next adjustment, that is tax. So balance relating to tax in the trial balance relates to under provision. Okay, this is clear. The balance relating to tax in the trial balance relates to under or over provision from the prior period. See, there has been some tax adjustments. They have given 130 in the credit side. This is a over provision. I have already given a explanation. Whenever you see debit, whenever you see tax amount in the debit side, it's under provision. Whenever you see the tax amount in the credit side, it's over provision. So there is a over provision this year. So we need to make less provision next year, or the estimates whatever we have made, we have to adjust this from that. That means this much extra requirement is not there in the next year. We need to adjust. So for that, what we will do? I'm leaving some space here. There is one more adjustment of uh, unwinding of discount. I'll explain that one, what that is. Unwinding of interest. Unwinding of interest, how to calculate, I'll explain. Working notes with respect to tax. So what they have given, 130. But this year tax estimate is how much? The balance relating to tax in the trial balance relates to under or over provision from the prior. The tax estimate for the year ended is 2.1 million. Current year estimate of tax. Then the over provision of the previous year, which we saw right now, 130, right? What they have. In addition to this, there has been a decrease in the taxable temporary differences of 2 million in the year. That means there is a reduction in the liability of like what is taxable temporary differences when you make financial reports and when you make tax returns. So financial report and tax returns, basically these two will be showing some differences due to different kind of treatments in both the statements. This works as per the tax rules. This works as per the gap. Maybe, for example, these people have, maybe as per the gap, you have to use straight line method, gap, or IFRS. Here we use IFRS, right? Straight line method for depreciation, and here they have a different. They ask you to use diminishing balance method for depreciation. So because of this, the treatments are different. There can be differences in the income, taxable income, and net income. So the temporary differences have decreased. So that will definitely impact the taxes. Yes or no? So decrease in taxable temporary differences of 2 million in this year. So differences have got reduced here. That will also reduce your tax payments. Yes or no? So Duggan company pays tax at 25%, and movements in deferred tax are also be taken in the statement of profit or loss. So any movement of that kind, we will adjust in the, we have to take in the financial statements. So now we will adjust that also, and we will take the entire amount of tax in the financial reports. So what is that? 2 million. 2 million is all like almost around 20 lakhs. So 20 lakhs into 25%. How much? 5 lakhs. 5 lakhs. 5 lakhs is nothing but 500 will take. We'll omit 3 zeros. Okay. So we will adjust this also because it is reducing our liability. So reducing the payment. So whatever the estimate we made was this, we adjusted over provision and taxable differences, which is also reducing the expense. We are adjusting that, and we are getting a final amount. 1470. Please have a look through this. Okay. There are some more sections, so we can take. So taxable temporary difference, which has got reduced, can reduce your deferred tax expenses. So deferred tax expense, it can reduce your deferred tax expense. So we calculated the tax expense right now. So it is a reduction in the tax expense. So we reduced it. Okay. We are moving forward. That means what happens if you have to understand very clearly, if taxation chapter is not done for uh, Rishita and Shweta. So see what happens is taxable temporary difference has got reduced here. That reduces your deferred tax expense or future tax expenses. How? Because your deferred tax liability decreases. So taxable temporary differences creates DTL. That means when financial reports and tax returns both are showing different figures of net income or financial income and taxable income, it creates a deferred tax liability. Okay. Okay. That why it creates a deferred tax liability? Maybe you have created a provision of 10,000 here for tax, and here you are making a payment of 7,000, okay, for tax. So extra 3,000 you need to make the payment. So it is creating a deferred tax liability. A small example I'm giving you. Okay, why here you are paying less? Because the taxable income is less. When the taxable income is less, you pay less taxes. Here the financial income is more, so your estimates are high. Since your estimate or provision is high and you pay less amount, there is a deferred tax liability created. Yes. So what they are saying, the taxable temporary difference, which is creating a deferred tax liability, it is decreased. Okay, that means the deferred tax liability here, let's say my deferred tax liability is 3,000. Let's say this is what is actual liability for me. Now it has got reduced from 3,000 to 1,000. Yes or no? So if there is a reduction in the deferred tax liability of 2,000, okay, that means this much less tax I need to pay. Previously, I paid how much? 3,000. Now I'm paying how much? Only I'm supposed to pay 1,000 because the liability has got reduced. So this is what is kind of a deferred tax credit for me. Okay. So my total tax expense will decrease because of this reduction. Everyone understood? Mansa, did you understand? Hello. Everyone of
Yes, sir.
you. Mansa, did you understand?
Yeah, sir, understood.
Yeah, your liability actually 10,000 is what is the estimate. You paid 7,000, and